Up until last week, 2024 had been a pretty good year for the business development company sector. The most popular business development company ETF, ticker BIZD, was up about 4.1% for the year before the sell-off. And although that doesn't sound like much, you need to take into account the dividends, which these companies normally yield between 8 and 10% on average. If you took the reinvested dividends into consideration, you can see that BIZD was up almost 10% for the first 7 months of the year. This is right around the average return of what the S&P 500 normally sees in a calendar year, and the BDC sector saw this in just the first 7 months. This can be attributed to the larger dividends a lot of these companies are still paying while interest rates remain high. If a BDC holds a lot of floating rate debt, which is what most BDCs focus on, then it's likely that they've increased their dividends or have paid special dividends in the last year. Obviously, given the market sell-off, things have taken a downturn for the time being. But Oaktree Specialty Lending, ticker OCSL, has been down for quite a few quarters while the majority of the sector has been doing very well. As I'll go into more detail, this company gave a lot of optimism in their Q2 results, which initially motivated me to remain invested in this company. But what we saw in their most recent results threw a wet blanket on their ongoing issues. I've discussed the backstory of this company a couple times. They were founded back in 2007, right before the financial crisis, which they not only survived, but they actually recovered pretty quickly from. They continued to do really well up until late 2011, when the company started going on a downward trajectory. This continued until 2017, when the company went through a dramatic strategy change. Brookfield Asset Management, a large Canadian investment manager, took over the struggling company in September of 2017. Brookfield made some pretty significant changes to this BDC, which included prioritizing safer investments. You can see their first lien debt went from only being 53.9% to 80.8% of their portfolio. This resulted in their credit rating being upgraded, and the number of non-accrual investments in their portfolio were nearly cut in half. Their stock share price stopped its free fall and actually saw some pretty significant growth for a BDC. Their net asset value consistently increased for years, and their dividends soared, increasing from 26 cents per share to 55 cents per share as of last quarter. That kind of dividend growth from a BDC is almost unheard of, and they even paid a couple special dividends here and there. It appeared that finally, after all these years of poor performance, that a more capable asset manager had come in and rescued this company, and they did an excellent job. This is what initially attracted me to this company. For so many years, this investment management team had done a really stellar job with this BDC. From the time Oaktree took over in 2017 to earlier this year, OCSL had provided investors with an average annual return of 9.9%, beating the overall market. But in the past few quarters, this company has been struggling with underwriting issues. A high number of non-accrual investments have been dragging down the performance of its portfolio and their dividend coverage. Non-accruals are the percentage of investments a BDC has that aren't earning them any interest due to the borrowers being financially stressed. In their second quarter results, Oaktree stated that they were making really great progress on their non-accruals. According to Matt Pendo, non-accruals had decreased from 4.3% in their portfolio to just 2.4% in Q2. That's a pretty dramatic improvement in just one quarter, which was my biggest motivator for remaining invested in this company. But last Tuesday, Oaktree announced that despite their recent improvement, their non-accruals had shot up again to 3.7%. This resulted in their net investment income dropping to 55 cents per share. With their latest dividend also being 55 cents per share, this gives them a payout ratio of 100%. For several quarters now, OCSL has been reporting lower and lower net investment income, and right now their payout ratio is right at 100%. My concern is if this company reports an increase in non-accruals in their next quarter, such as going up to 4.3% like they were in Q1, then that'll likely push their payout ratio to over 100%. That doesn't guarantee a dividend cut though. It does happen from time to time where a REIT or a BDC will post a payout ratio of over 100%, but they won't need to cut their dividend. Sometimes these companies will just report really bad quarters, but they're always one-off situations. My concern is that OCSL has been on a downward trajectory now for several quarters and it's not getting any better. One positive OCSL has is that they have a very high amount of cash on their balance sheet, which is really unusual. They currently have the same amount of cash as BDCs that are significantly larger than them. I'm not exactly sure why this company currently has so much cash on their balance sheet. It could be they did see issues coming. But if the stock briefly crosses over 100% in terms of a payout ratio, they do have the capability to keep their dividend at its current level if they choose to do so. There is some good news that this company should benefit from, although we haven't seen it yet. On April 30th, Oaktree made a really exciting announcement about their base management fee. They announced that they would be permanently reducing their fee from 1.5% to 1%. Business development companies charge a management fee that's kind of similar to an expense ratio for an ETF or a mutual fund. It's how the management team gets paid, and it's a pretty unusual move for them to reduce it. There's no mistaking that it was a very noble thing for them to do. It does show that they have the best interest of their investors at heart. The reduction has already gone into effect though, and what's unfortunate is that it appears it didn't make any impact this quarter. According to the original press release, it's supposed to save the company approximately 15 cents per share annually, or 3 to 4 cents per quarter. But still, with its net asset value falling, it's likely this company will continue to experience issues with covering their dividend, let alone growing it. One additional piece of discouragement from their April earnings call was the reason they gave for their fall in Q2's net investment income. In Q2, it was said that their worst performance was due to issues revolving around the timing of repayments. So apparently a borrower owed the company money, which they received, but they wouldn't be able to report it until the next quarter. That was their first explanation as to why in April they saw their NII fall again. That didn't appear to be an issue this time around, and again, it didn't make any impact for this company or its earnings. So considering the path this company keeps going down and their inability to turn their results around, I decided to exit my position for the time being. I will say this though, we saw that this company has a very good history of growing their NAV and their dividends during less stressful conditions. OCSL is currently going through a very difficult situation for the time being, but we could potentially see them going back to the kind of growth that we saw between 2020 and 2022 eventually. I don't think it's worth shunning this company completely, given how successful they were for many years. The way I see it though is that we don't know how long it'll take for OCSL to recover. We could be talking a matter of months or years, and I'm just choosing not to ride things out. I'm interested in pursuing other opportunities out there that exist. It's a difficult lesson for this company that they'll hopefully keep in mind for the future. And if you're concerned about the BDC sector in general, I'll name some companies in this field that are still doing really well from a NAV and dividend coverage perspective. Ares Capital just reported their earnings last week, and they currently have a dividend payout ratio of just 78.6%, which is pretty good for this kind of company. Their NAV also saw a sizable amount of growth compared to the previous quarter. Capital Southwest is another BDC that just reported their earnings yesterday. They announced a dividend increase and a special dividend on top of that. One more company is Blue Owl Capital, which has seen a tiny amount of growth, but they also have a very solid amount of dividend coverage of 78.7%. I would recommend these companies instead of OCSL. I also want to make it clear that I didn't try to time my selling of this stock. Oaktree just so happened to post really bad results during a market-wide sell-off. Unfortunately, it made the situation worse, but it didn't influence my decision. It's just ultimately a series of unfortunate conditions for one of my former favorite holdings that I'll either replace or invest into holdings I already own. But with that being said, that's going to conclude today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.